Hey everyone, me Kevin here. Something just happened that has not happened since April of 2020. And honestly, if you're investing in the stock market, the last thing you want to hear is anything relating back to the depths of the pandemic, unless we're talking about stock prices, because, well, stock prices, as you know, were quite low in April of 2020, but there was a lot of panic here, and data looked really bad in April of 2020. Because it was before we actually had our stimulus and our bailouts. Well, now we've got actual economic data that's starting to look like April of 2020. At least it's the lowest data that we just got since April of 2020. And it's concerning for a particular breed of stocks. And I want to talk about those in this video. So keep this in mind about April 2020 and what it's going to mean for specific stocks. We're going to talk about that. I also do want you to mark on your calendar, if you don't mind, July 25th. We are releasing more AI lectures, and we are increasing the price of the stocks course, the AI and income course, the do-it-yourself property management course, the real estate investing course. A lot of amazing and excellent content here. Check that out via the links down below, or go to meetkevin.com to learn more. You could buy now, pay later for these as well. Works out to somewhere around $30-40 a month if you use one of those, and you get access, unlimited access and lifetime access to all those course member live streams. Check them out, link down below. So getting started, first, we already know some things here, right? We already know that interest rates are skyrocketing. This is the 60-month, which is 5-year. I know 60-month is written in a weird way, but 60-month is 5-year. 5-year new car interest rate, and as you can see, it's, well, let's just say it's getting a wee bit expensive again. But it's not just car loans, folks. It's also credit card interest, which is skyrocketing. Obviously, as the Federal Reserve started raising rates since March of 2022, you would expect this. Keep March of 2022 in mind, because there's going to be another aspect that relates to March of 2022 as well. Let's keep going with this data first and then try to make some conclusions. We just today received this information, the change in revolving credit, the monthly change in revolving credit. And the monthly change came in for revolving credit of somewhere around 8.49. So what is revolving credit, first of all, and how does that compare to non-revolving credit? Well, the way to think about that is very simply. So revolving credit is going to be anything that you can pull out on a regular basis and you pay sort of variable payments on. So think about it like a credit line or any kind of maybe personal line of credit, or even to some extent a business line of credit would be a form of revolver. But since this is having to do with consumers, we're going to get rid of the business line of credit here. Blocks, PLOCs, HELOCs, right? We're just going to be focused on these sorts of things. So these are going to be credit cards, which is a line of credit, is a type of line of credit, and other personal lines of credit that you can get at a bank or like a SoFi personal loan, whatever, right? So those are typically your revolving credit debts. And we could see those are continuing at a regular pace. In fact, let's go back to that particular chart right here, and we could see revolving credit. While there's some volatility, as you could see in the variations here in the different monthly reads, it seems to be relatively consistent. People are still borrowing money from revolving lines of credit. So credit card debt still expanding to some level, though nowhere near as high as what we once saw at the beginning around March of 2022. You saw this explosion in credit card financing, and that led a lot of people to worry, oh my gosh, we're about to have a poop show of people borrowing too much. You've actually seen that stabilize to more recently normalized levels. Though if you go historical, you're still relatively high. You really haven't seen this type of borrowing since over here in about 2007, which is also somewhat scary because it means if we're borrowing like we were back in 2007, is that an indicator that maybe we're going to trend back into a 2008 style recession where that borrowing really plummets, right? So we got to keep an eye on this. Right now, this is still mostly healthy. So what would that mean? Well, that would mean maybe your credit card type spending, your consumer goods, your travel, your airfare, your Etsy's, your Amazon, you're still getting that kind of spending. Okay, great. So what's the surprise then? Well, the surprise is that we actually got a pretty low in total consumer credit monthly change. This is the total chart here. And you can see that blue line just carries us over all the way back to the end of 2020. You didn't actually have this low of an increase in consumer credit for roughly the last 2 years. And that's a little bit of a surprise. So something had to tank this chart. And what tanked this chart was actually this right here, non-revolving credit monthly change. There it is. We have not seen non-revolving change of credit go negative since April of 2020 during the COVID era. Now this is a little weird. Why would this go so negative? All of a sudden, we're seeing this massive decline in non-revolving credit. What is non-revolving credit? Well, non-revolving credit, and all of this credit, by the way, is not related to household credit. That's important. That'll be part of our conclusion in just a moment. But non-revolving credit has to do with student loans and car loans generally. These are going to be things you take out and then you pay a fixed amount for until you've paid it off. Student loans, cars, and household. But this is consumer credit, so you actually remove the household. So it's just cars and student loans, which is really interesting. Why would we potentially see car debt plummet like this? And there are two main arguments or explanations for this, but we're going to look a little bit further by providing a little bit more data first. And I think with a little bit more data, we might be able to find out what's going on. Before we start coming to conclusions and suggesting that's it, the auto market is dead, there are some extra pieces we need to pay attention to, specifically the difference between non-housing debt and housing debt. This gives us a Q4 2022 to Q1 2023 set of data. So it's a little bit dated, but it shows us a trajectory change. And what you can see here is you've really had this non-housing debt slow down, whereas household debt, while it's also slowing down, it's not slowing down as much. In fact, the growth of these two lines, I did the math for us, the growth in non-housing debt is 0.43%, and the growth in housing debt is 0.98%, which is roughly 2x. So in other words, you're growing housing debt at roughly twice the rate you are now growing consumer non-housing debt. Now, why does that matter so much? Why would I bring that up? Well, I bring it up to help us understand a potential conclusion, because there's going to be a lot of fear, uncertainty, and doubt around these consumer credit figures. And there are two realistic explanations here. One of them is fuddy. One of them is no or less fuddy. What you're going to hear the bears say is that we are on the way back to 2008. This is a credit crunch. We are finally seeing the impact of higher interest rates affect the consumer because credit card rates, as we saw in the beginning, and car loans are so high. What are people naturally doing? They are reducing their borrowing. Maybe that makes sense. Maybe that is entirely the explanation. And that would be a negative factor for, in my opinion, your consumer spend categories. So these are going to be your consumer discretionaries. Again, your Etsy, your credit card companies, your American Express, your airlines like a United Airlines, potentially even your travel sectors in hotels, your Airbnbs, whatever. Maybe we get through the summer boom and then what? Oops, now we're in recession. Bloomberg economists still think we're going to be in a recession in Q4. I'll tell you right now, it doesn't feel like we're in a recession. A lot of people are thinking we're not going to go into one, but this is at least the consensus and potentially an argument that would make sense. It's expensive to borrow, so let's borrow less. There is, however, one other explanation, and I'm not by any means trying to come across as, okay, let's just look for a potential excuse and, a bull excuse. This is actually something that I have seen anecdotally, and then I've started looking for data to either confirm or dispute this. In English, a few weeks ago, I was talking to some notaries, and they're like, we are seeing an explosion in people borrowing money through HELOCs. Really? HELOCs. Okay, well, what is a HELOC? A HELOC is a home equity line of credit. So in order to get a home equity line of credit, you have to have, guess what? Home equity. But let's say this. Let's say you owe $400. That's how much you owe. And you have a $600,000 property. Maybe that property was worth $620 at the peak in May of 2022. It's come down to, let's say, I don't know, $560 in December of 2022. And it's gone back up to about $600 thanks to super low inventory. Still have not seen an inventory surge, mind you, even though rates are at the highest level they've been at in this entire tightening cycle, like 7.32% for a 30-year fixed right now. Prices have already started trending up again from December and January because inventory is so low. Keep in mind that creates real risks for the real estate market if inventory starts rising again, because that'll give more choice to buyers, which could press prices down again, and you potentially end up with this sort of nasty-looking real estate movement here. But ignore the real estate speculation for a moment. That's just speculation. What does this enable you to do? Well, it enables you to take out homeowner equity again. Now people are starting to see stocks rise, and there's a potential FOMO of wanting to get into stocks as well as spend money on not credit cards or car loans. So what do? You call up your banker and say, look, I owe about 66.67% on my house right now. I want to borrow up to 80 to 90%. Can you give me a line of credit? Well, what is that going to look like? Well, if you get an 80% loan to value loan on $600K, you're looking at about $480,000, which means you could pull out $80,000 of new money that you could just pull out on a line of credit. If you go up to 90%, you could potentially pull out $160,000. So what does this mean? You borrow money here, and then what do? Then you pay cash for things that homeowners pay cash for. What is that? Solar, cars, businesses, stocks. So this way, you actually maintain your low interest rate on your original loan, and you're only paying higher, 7 to 8% interest on the new money. But now you take that money as a homeowner and you spend it on maybe a new rental property, a business, stocks, cars, or solar. That would actually lower consumer non-housing debt. So I actually think a HELOC refinancing boom is potentially causing these consumer credit numbers to look really, really scary, when the reality is we're just using the piggy bank of our homes. Now, if you thought this was interesting and you're like, wow, I haven't heard anybody talk about this before, imagine the kind of things you would learn in my courses on building your wealth. Make sure to join those before July 25th, because we are expecting one of the largest price increases for this year to be on July 25th. If you have a question, send us an email at staff@meetkevin.com. We'd love to have you there. Remember, you get lifetime access to the content. You get lifetime access to the live streams with me, where we can do Q&A and discussions, fundamental analysis, real estate, entrepreneurship, you name it. And you get all of the future lectures that we release totally for free. So check out these programs, as well as my buy, sell, and alerts for stocks, what I do with my personal portfolio, what I'm doing when I reallocate in terms of my fundamental analysis, what am I thinking, how am I repositioning with stocks in terms of fundamental analysis, and what are some of my latest thoughts before they make it here on the channel. Some of those thoughts never make it here on the channel. Check that out in the private courses, link down below. Thanks so much for watching, and we'll see you in the next one. Goodbye.